Hello, this is Luke McCarty with McPherson Financial Group here for our second quarter 2022 update. And what a wild first half of the year it has been. Some of our predictions came true with the volatility, but not necessarily on the downside when it came to the stocks and the bond market. So let's jump right in. First thing I want to show you is our economic indicators. We have three negative indicators currently. So housing starts, right? There's the increase in interest rates, right? A mortgage right now is in the fives. It used to be 2.5. Real personal income. If you haven't received currently a 9.1% raise, you have less money. Retail sales is very cautionary. That means the consumer is potentially pulling back as things get more and more expensive. What's been really strong with our economy is the civilian labor force. So unemployment has not increased, and also industrial production is still very strong. If four of these turn negative, we're looking at something similar from an economic standpoint to 2008, 2009. Now, I'm not predicting that, but that's what these indicators showed us in 08 and 09. They were all negative, but four being negative is very cautionary. We've made several moves throughout this year, a lot of moves in our accounts at Fidelity and Schwab in the second quarter. We are currently sitting, anywhere from 80 to 90% cash in our models, but we're going to go through a few things and show you some reasons why we think now may be the time to buy in about 25. And that's exactly what we did last week. So annual performance, when we look at our performance year to date of the stock model, right? Covered calls, 50 stock, equity income balanced. Our equity income balanced is still our best performing model from a risk adjusted basis. It's still down about 9%, but the index, the benchmark is down 14. So all of our models are now outperforming the benchmark, meaning we are outperforming the market in general. So that is a good sign, even though everything here is a negative. A lot of moves that we made earlier in the year to help get us out of the market has helped. Being out of the market in June helped a lot, as June was a negative month. For instance, when we look at the stock model there at the top, the S&P 500 at the end of June was down almost 20%. So, that's not our benchmark because we have mid cap, small cap, value, things like that in there as well. But the S&P is down about 20% as of June. So relate some of those numbers to some of these, and you can see what would have happened if we just owned the S&P 500. Here's our performance of our mutual fund and ETF models. The max growth model still struggled a little bit. We have some, we're revamping things as we get back into the markets, trying to simplify that model. Our balanced and conservative accounts, our balanced account was actually down less than our conservative and our income. That is because, some of the investments in the balanced from a stock perspective actually outperformed the bond market. So the bond market through June is down, about 10% on average, but you have some high yield bonds down 14 or 15%. That is an incredible move in the bond market, ones that we have not seen before. We're looking back to, late 70s, early 80s, the bond market still wasn't this negative. So that's a big move in bonds. The bond market seems to be forecasting or showing us that, hey, the Fed's going to raise rates even more, or inflation is higher than expected, which we just saw this last week when inflation came out at 9.1%. So here's a chart of the CPI inflation. It is the highest inflationary rate since 1981. So we're seeing things go up and go up really fast. The expectations, for June on inflation, was 8.8%. We came in at 9.1, up from 8.6 in May. So inflation is definitely rising, but we feel it may have peaked. The reasoning of that is because the oil market, right? Oil and gas is down, right? Down in the month of July, not June, right? Your wheat, your copper, fertilizer, corn, a lot of your commodities are starting to fall off and starting to lose value. But, lumber, for instance, but this is more than likely because of what the Federal Reserve is doing and what they're going to have to do to fight inflation is they're going to have to slow the economy even more. We are technically in a recession with 2 negative quarters of GDP, but our viewpoints on on a recession include, a loss of jobs, unemployment, earnings of corporations. We haven't seen a lot of those fall off yet, and hopefully we don't. The federal funds rate. So what is the Fed going to do? The blue line here on the right is the Fed's year-end estimate. So the Fed is expecting to get to about a 3.4% federal funds rate by the end of the year. We're currently at the 1.63 mark. So the Fed has quite a bit to do to get there. Now the Fed meets end of July. It was priced in about 75 basis points of an increase. Now there's a potential for 100 basis points or 1%. That's because inflation came in higher than expected. But in the long run, the Fed looks to get to about, call it 3.5% by the end of the year. That's what the market is expecting in the green. However, the Fed thinks or feels they can continue to increase rates next year. This is where there's a difference, right? The market feels that the Fed's actually going to drop rates next year and lower rates because of this extreme slowdown in the economy that could happen if rates get this high that fast. I've seen a lot of analyst estimates and some things I agree with, where the Fed, they meet at the end of July, they don't meet in August. So they don't meet again until September. When you get to September, October timeframe, you're getting more into the midterms. So I feel that, the Fed's going to slow down once we get to September, October timeframe to try to be non-political in what they're doing. That slowdown is going to help the markets. It could potentially help the markets rally. Now, this is all dependent on, did we really have peak inflation in June of 9.1%? We'll see next month what July prints out, but there's a lot of things that are coming down, even though if we don't feel them necessarily in food, we can feel them at the gas pump. But there's, signs of a slowdown in pricing. And a lot of that's because a recession is potentially coming or baked into some of the pricing. All right, when looking at the S&P 500, this gray line is the S&P 500 on a PE ratio, price to earnings ratio. You can see that middle line, the middle green dashed line is our 25-year average. So historically, when you get above or below, or at the top green line and the bottom green line, one standard deviation above the average, you are overextended. So we haven't been as extended as we were end of last year since, the dot-com, late 90s, early 2000s. We got there. Now we're kind of falling back towards the average. This is a potential sign for, buying back into the market and, continuing purchases. Unless an event like 2008 and 2009 were to happen, we will more than likely stay above, the 13.5, the negative one standard deviation or one standard deviation below the average. But you can see here, because of the drop in the stock market, the price to earnings ratio has fallen off dramatically. And what this says, in layman's terms, is that stocks are historically averaged priced. If you get too high, they're expensive; too low, they're cheap. But we're pretty much on the average price right now, and still going down a little bit. Here's a quick history of the S&P 500. So the first half of the year, right, there's only been 5 times since 1930 where the first half of the year in the S&P 500 was down 15% or more. Our first half decline for this year, right, negative 20.58. So this has only happened 5 times. So this is how historical of a move we've seen this year in the stock market. You can look at some of these years. It hasn't happened since 70, right? Then 62, 40, then 39, then 32. So what this chart is showing is that it's happened 5 times. All 5 times that it's happened prior to this time, the market has been positive the rest of the year. Now we are in a midterm year. We do have the Fed. We do have inflation. We have a lot going on. But this is telling that, there is room for us to kind of rebound out of the market bottom that we're in and kind of rally the second half. That was part of our predictions from our, 2022 outlook was we're going to have a rocky first half of the year followed by a rally in the second half. My definition of rocky was not happening one of 5 times over the last 80 or 90 years, but that's what happened. So the rest of the year, from this chart, from this perspective, we would expect something positive to happen in the last half of the year. All right. Once again, I'm Luke McCarty with McPherson Financial Group. There's my email. There's Art's email. Call us if you have any questions. Thank you for watching. Look forward to talking to you all.